We are recording right now.
Thank you, Adrian. And do we have a quorum of the committee?
Yes.
Excellent. Good afternoon and welcome to the Finance Administration Procurement Subcommittee meeting of July the 9th. It's currently 12:21. And Adrian, I'd ask you to take roll, please.
Yes, hold on just one second. Yes, Member Baez. Member Marquez.
Present.
Member McCarthy. Member Nehrum.
Here.
Chair Hannon.
Here.
We have a quorum.
Thank you. Item 2 is public comment. This is an opportunity for the public to speak on any item that's not currently on the agenda today. Do we have any speaker cards or anybody in the attendees list that has indicated that he would like to speak?
We have no speaker cards for this item, and I do not see hands raised for public comment.
Great, thank you very much. So we'll move on to item 3, which is approval of the minutes from May 7th, 2021. I'll look for a motion on this.
I'll move approval of the minutes from May, from the May committee meeting.
You know, Kathy, that was my birthday, May 7th. How soon you forget.
I'm sorry. May 7th, duly noted, Mike's birthday. Happy belated birthday.
Thank you. We have a motion from Kathy, and I didn't catch the second.
Marquez.
Thank you, Alyssa. I appreciate that. So yeah. The second. Roll call on that, please.
Great. Member Baez. Member Marquez.
Yes.
Member McCarthy. Member Nehrum.
Yes.
Chair Hannon.
Yes. So that passes. Thank you. Item 4 is the fiscal year 2021 quarter 3 financial statements. This is an informational item. I'll turn it over to staff. Hi, Howard.
Hello. Let's get that item up. And Jason, I believe you're gonna present on this.
Yes, thank you. Adrian, can you please move to the next page? Yes, and can you zoom out a little bit, perhaps? Is that possible?
Yes.
Maybe to 100%?
Yes.
Perfect, thank you. So scroll up just a touch. Yes, so this is known as our statement of net position, and that's the public equivalent of a balance sheet. And we see here that what we have is, this is for the year, this is for total current position as of March 31st, 2021. That has our list of total assets here, which the highlights include cash and cash equivalents. That is actually what is sitting in our accounts. Accounts receivable and accrued revenue are as they are, that they're payments from customers that we are waiting, or that we're waiting on for various things. Market settlements is, we kind of prepay for some of our energy positions, and then that settles later when it can take us a little bit of time at the Cal ISO. So that is what we believe to be the credit coming to us on that. And then there's some prepaid energy purchases, and then we do have a bit of restricted cash. That $10 million in restricted cash is $7 million that we hold in reserves for our Barclays credit facility, and then $3 million that they hold in reserve in our lockbox at our lockbox account. And so if we go to non-current assets, we have the 12.68 million that is our GASB 62 rate stabilization fund. These are deferred revenues from last year that we have not yet realized. And then we are holding some deposits as well. Our liabilities in relation are much smaller. Basically, it's just the accrued cost of electricity And that is, similar to the settlements. It's basically energy that we've already brought onto the grid, and we're just waiting for payments to settle. And then we do have some UUT charges that do go out to the various jurisdictional constituents that's in flux. And then, then there's that ultimately gets us to our net position, which, as we see, is basically a balance of our unrestricted accounts plus some restricted, and then our investment in capital assets. This is just mostly office equipment and stuff that kind of depreciates over time. If there are any questions on this, we can go to the next one. So in our statement of revenue, expenses, and change in net position, this is the government equivalent of an income statement. And so this has the two columns. One is the year to date on the far right, and then the quarter from so year to date being from July 1, 2020 to March 31, 2021. And then the quarter is from January 1st, 2021 to March 31st, 2021. And we have our operating revenue, which comes from the sale of electricity. We do have some other revenue that generally comes from grants or any interest we collect on cash that is sitting in our accounts. And then that gives us interest is on non-operating revenue, my mistake. Other revenue in operating is in fact grants. And so then we get to operating expenses, where this last quarter, we spent $85.3 million on the cost of electricity. We did have some contractual services with vendors that costs that had, and that's what that line item is for $3.3 million. Then obviously payroll and related staff compensation and benefits. G&A is other operational stuff such as rent, memberships that are required for various operational purposes and whatnot, and then some depreciation to get our total operating expenses for the quarter to be $91.4 million. So we had a bit of a dip in this quarter, and it's usually the case that we see that in this first quarter because of the business cycle. Rates are generally lower during this time of year. But that puts our year to date at 19 million positive. We do have then some non-operating expenses and interest. The interest comes from the cash that sits in our accounts. We accrue a very small rate. It's about 0.4%. It's just what the bank pays us. Those aren't investments or anything. That's just cash in a savings account. The finance expenses are what we pay to Barclays to maintain our credit facility, either with a commitment fee or with any costs as they relate to letters of credit that we have outstanding, that we use in lieu of cash collateral. And so then that gives us the change in net position, with the net position at the beginning of the period and the net position at the end of the period, to give us our net positional balance. If we can move to the next one, if there are no questions.
Excuse me, I do have a question on that.
Okay, very good.
And under the operating expenses, specifically the general administrative.
Yes.
This may be kind of nitpicky, but when I take the quarter expenses, and you multiply it by 3, it's quite a bit higher than the year to date. And I was wondering if there was something or some reason why those would be higher than typically what we'd had maybe in the first 2 quarters.
Yeah, that's a very good question. The nature of G&A isn't, is kind of blocky. It's much of it is on an as needed basis rather than a peanut butter kind of basis where we spread it out through the quarters. When we do our budget, we do spread it out evenly through the quarters, because it's just impossible to tell when a specific, when are we going to attend a conference. If we budget $1,000 for a conference attendance, we don't know in what time of the year that's going to happen. It might happen in the first quarter, it might happen in the third, kind of thing. So on our budget, we do kind of spread it out, but in the actual accruals, it can be a little bit more blocky like this.
And I'll just comment that the substantive chunkiness that Jason's kind of referring to it's all generally consultants that causes that. So when we get an invoice, when that actually when we actually get charged those costs, it can swing $100,000-$200,000 based off of some of that work.
So then when we project out for the entire year, are we expecting then that line item to be within budget?
Absolutely. Yeah.
Absolutely.
Okay. I mean, because I'm kind of new on this, and so I don't have the familiarity maybe some others do, but that just stuck out at me that it seemed much higher this third quarter than the other two quarters.
Yeah, and I would just comment that obviously this doesn't reflect our sort of forecasted budget, but when we brought forth the budget in June to pass, we did show a forecast of our year-to-date budget, and it is all coming in line. If anything, all of our generally our G&A expenses are coming in under budget significantly. Okay. So yeah.
Okay. Thank you.
Let me follow up on Kathy's question, Howard, because I normally look at budget documents, and these are more the financial statements, but is there somewhere where you can put a footnote to indicate on the financial statements that the expenses or the revenues are coming in at significantly greater or less than what we had anticipated? Or is that, again, just really more a part of the budget process and not really the financial statements?
Yeah, we generally, financial statements generally are in accordance with GAAP. So this is very standardized, and it would be very unusual to show a budget in there and a change budget. We can, as a separate, document, happy to go over a budget to actuals view of things, but it would be very uncommon to do that in a GAAP set of financial statements.
Well, then maybe I'll ask in the future as we go over the financial statements, just as an addendum, that if there's anything significant that was unforeseen in terms of either the revenue or the expenses, that you highlight that to us so that we're not trying to recall what the financial statements look like at any particular time in a quarter, as opposed to the entire year process.
Yeah, we're happy to do that. Just as an FYI, we do that as a mid-year check-in, and then we do it with the budget setting process in June. It's just a separate, it's a separate process from this, though we can do it more regularly if that's desired.
I'm okay with that. I don't want to create additional work. If we're doing it every 6 months and then annually, I'm fine with that as well. Thank you.
Thank you both. Those are good points and good questions. So the rest of the statement is the cash flow, which operates kind of differently. These two statements are accrual. The cash flow statement is obviously cash, so it looks a little different. If we can scroll down, Adrian. And it breaks it out by certain activities. Our cash flow from operating activities shows a net position, even though our accruals show a negative position. And that's just because that's the timing of cash, not the timing of accruing a cost or a revenue. And so then we also have, so in various different other activities, non-capital financing, that's, what we're paying to Barclays to hold the credit facility, capital and related acquisition of capital assets. That is the purchase of office equipment during the quarter. And then interest received, as we said, that's just what we receive from the bank holding our cash in savings style accounts. And then it reconciles with the net position down at the bottom to kind of true up, very similar to how it does on an accrual process. It does it on a cash basis as well.
Excuse me, I have another question on this,
Yes.
if I may, please. At the top, receipts from customers, same kind of question. I only see, what is it, 102 million for the quarter? And that seems to be substantially less than the year to date. And I was
Yeah.
wondering, is that due to less electricity sold in the third quarter? Or is that a combination of less electricity and more delinquent accounts?
Yeah, that's a very good question and very astute too, because it does consist of a few different components. The first is what you really hit the nail on, which is that, rates are lower in this third quarter. So the receipts that we get are going to be lower because they may be using the same amount of energy, but we're collecting less because it's just winter rates as opposed to summer rates, which we do collect in the first and second quarter. So that's probably 95% of that difference. Then there is, of course, yes, some delinquency that is occurring, but our current tracking of that shows that those outstanding accounts are diminishing. And that is that as people are returning to work, they are paying back their older bills. And then, looking forward, we do have some programs that we are implementing for bill support, as well as, getting involved with the AMP process with PG&E and a couple other of bill forgiveness ventures.
I'll just note, this is not largely driven by delinquencies.
Yeah.
It is. We are not seeing an increase in delinquencies that are driving lower receipts in this material manner. It is entirely from the seasonality of winter rates versus summer rates, with Q3 always being the softest quarter that we have in a fiscal year.
So if I went back and looked at the cost of electricity for the third quarter, would that show up substantially less than, say, quarter one and quarter two?
Yes.
Generally speaking, it will be less. So Q3 being January through the March timeframe, it's entirely winter rates, whereas say April through June is partial winter, partial summer, and then July through September is entirely summer rates. And then in the fall, you get a mix of summer and winter rates. So this is the one quarter where the rates are the lowest. And then from an energy expense perspective, it is generally lower due to slightly lower load, with really March being a very soft month because fairly mild temperatures. January, February, can be cold months, and so you can still see high energy prices, but on average, you have lower energy prices through that quarter.
Okay, and is there anywhere on here that shows, or there's a number for the delinquency that's owed to EBCE?
It is not shown in our financial statements.
Okay.
These being GAAP statements, it does not come up in here.
That will be showed on the treasurer's report, which will be at the board meeting this month.
Okay, all right, thank you.
Great. So if there aren't any more questions, this concludes this item.
I just have two quick questions. One, we're going to see a significant increase in our expenses and receipts because Pleasanton, Tracy, and Newark all came on board in April. Is that correct?
Yes, in April.
So we'll see some changes there. And then, Jason, if you would go back to the memoranda that was submitted with the financial statements, I was just curious about some of the language that was in the memoranda. As I read it, it almost sounds like we kind of checked all the figures all add up, and that's really the extent of our involvement. Is that the way really I should read that?
Yeah, this is the statement from our accountant who compiles our financial statements. And yeah, basically saying to the best of his knowledge, this is as true and accurate as we can make it at this time.
So really all they're looking at this point are the actual numbers, and they all make sense and they all add up correctly. They're not getting into any of the substantive issues as it involves any of those numbers per se. Is that correct?
Right. Yeah.
Okay.
Yeah.
Yeah, that would be
And-
something an audit
Yeah.
would do, and this is not an audit of that.
That's right. These are all, because these are quarterly statements, these are unaudited. And so, you know, we turn these around in about 45 days, although this review is a pretty delayed review just due to when the FAT meeting was scheduled. The annual statement is an audited statement. That, you know, that is a 3 to 4 month process. We'll present that in the October timeframe. So that's much more formal. These are subject to change as we continue to reconcile, close books
Sure.
through the annual process.
Great. I'm going to look to the attendees to see if there's anyone that has any questions. If you have any
Hey, Chair, could I
questions,
ask
I'm sorry, Kathy.
follow-up question
Sure.
for yours? In that second paragraph from the accountant, could you elaborate a little bit on the statement, you know, that management has elected to admit the note disclosures and things, and the concern that if there were there, that people might not necessarily, or might have some concern about the financial position of.
Yeah, I could, sorry. Yes, I can speak to this. So in our annual audit, we have a very extensive note disclosure that goes into the various different forms of the financial operations. That requires the audit to flush out in an unaudited financial statement that, you know, it cannot be, it's easier to leave those notes out because of the just the uncertainty in their nature and still being enacted through the fiscal year.
This is very standard, just to be clear. So an unaudited quarterly financials, it would be uncommon to sort of include very extensive notes, whereas in a annual audited financial statements, you put quite a bit more effort, which is why it takes sort of 4 months to pull all that together, and that's where you would include all of those notes.
Right, and so exactly, and to expand on that, this is not saying that any numerical information has been omitted. It is only footnotes, so to speak.
It's not even footnotes, just to be clear.
Right.
There are explicit notes in an audited financial statement, you know, probably 5, 6, 8 more pages worth of notes detailing each section. And that's not something that we do in quarterly statements, mostly because they're subject to change and due to sort of contractual obligations to have to get these statements out within 45 days.
And Howard, is this the same accountant firm that does the annual audit for us as well?
No, just to be clear, Mar is our accountant. We have a separate auditor, which is required as a third party, and that is Pizzeni and Brinker.
Is it possible, because I certainly appreciated Kathy's questions, is it possible for our accountant to include that statement that the additional note disclosures and things of that nature are presented as part of the annual audit? So it kind of softens that, what appears to be kind of a negative statement.
Right.
I think that would be fine if we wanted to include a sentence, say notes are included in the annual statement. For those that generally review this, creditors, you should be aware that they're not expecting any notes. We have many counterparties, dozens of counterparties that reviewed our financial statements, and they never ask for notes. They know that it's not part of the standard process, but it wouldn't be a problem to add a sentence to that nature.
And I would encourage you to do that. And I'm not worried about the bankers who understand this process. I'm worried about the citizen that all of a sudden starts to look at some of these statements and
Right.
see that we elected to omit substantial, that never sounds really good. I think if we just put a
Yeah,
statement in there-
understood. Yeah, there's a perception issue of how that
Yeah.
reads.
Yeah, I mean,
We
it
appreciate that.
sounds almost like we're hiding something if you're not fully informed, and I assume that's not the case.
That's not the case. Yeah.
I hope
Yeah,
that's not the
certainly not.
case.
I appreciate where you're coming from with that. Yeah, and we can certainly elaborate on that to make that clear.
Perfect. So again, I'll look to any attendees to see if there's any questions. And I see Alyssa has a question. Alyssa.
Yes, thank you. I was just curious, since starting in January, the 2 default options are going to be renewable 100 and Bright Choice. Are we going to be tracking how many customers are in each program and just kind of parsing out the revenue from the two different options?
We certainly have all of that tracked internally. We do not disclose that in financial statements. So we have that information, yeah, but it wouldn't be common to sort of show that level of detail in something like this. Again, this being in accordance with GAAP, that level of detail wouldn't typically be in there.
Okay, but that information could be shared with the board during
absolutely, yeah.
updates. Okay.
Yes.
Okay, thank you.
And just to follow up on Alyssa's comment, in what form would that be shared with the board? Is that something that you present to us on a periodic basis in terms of the breakdown of the different customer? I think it is in terms of where the customers are in terms of each one of the programs. And I think you actually do that by city, if I'm not mistaken.
We've done that in a few different ways. I think in the power content label itself, it'll sort of disclose the different product types that we have and the load associated with each. We don't usually do that. I mean, we've had a number of budget-related items that touch on this. So in the past, I've spoken to a number of customers on Brilliant 100. Obviously, there have been extensive conversations on that. It's not necessarily in a standard quarterly report to show that breakdown. Happy to do that, but I don't think it hasn't been a request in the past, basically.
And maybe as we get closer to transitioning from the Brilliant 100 to those other energy choices, maybe that would be the opportune time to show that.
Yeah, I think certainly we will likely, given the transitions happening at somewhat different timeframes, keep in mind, but and some of those decisions are still to be determined by the various cities. But I think we would absolutely plan to bring forward an item at some point to say this is how the transition has been managed, and this is now where all those where the various cities or customers sit in the new default box, if you will.
Perfect, Howard. Thank you. Jason, you had a comment?
Yes, thank you. I would just like to, based on the comments that were made earlier and then the change of discussion, I would like to wrap up the previous comment regarding the omitted notes. And I would like to draw attention to the second sentence in that second paragraph where it does state that EBCE's annual audited financial statements include the notes disclosures omitted from these interim statements. And I would, in my understanding, based on what was asked earlier, I wanted to check to see if that conforms with the expectation of that request.
I would think so. Kathy, do you see that second sentence? I think that pretty much addresses our comment. It does indicate that EBCE annual audited financial statements do include the note disclosures omitted from this interim. I'm okay with that. Any thoughts from any other board member?
Well, I'm okay with it. It's kind of buried. I mean, you get hit first with, we've elected to omit substantially all of the note disclosures required by, accounting principles in these interim statements.
Yeah.
Would you like us to literally move the second sentence first, so it sort of starts the paragraph saying
that might help.
Statements include notes. These don't include notes, as opposed to we don't include notes, and then you kind of lose the subtext, maybe.
Perfect.
Yeah, I mean, it just comes across like we're not being fully transparent, and that's obviously not the intent.
That's a good suggestion, Howard.
Okay,
thank you.
We'll do that, and happy to take any further guidance if you think of other sort of adjustments you'd like to see.
Great. So this was an informational item. Seeing that there's no other hands raised, we'll go ahead and move on to item number 5, prepaid transaction overview.
Great. All right. So we have presented on the prepaid transaction now a number of times associated with getting different vendors enabled, and then just providing a few different overviews, both with the FAP executive committee as well as the full board. So hopefully this topic at this stage is one that is you're very familiar with, though I can appreciate this is a pretty complicated structure and transaction. So we were given specific direction to make sure to bring this back a number of times. The more repetition with it, the better. So we are now nearing the time frame where we want to go out to market and execute on this transaction. So This, of course, being an informational item to the FAP, we are looking to bring this to the full board in July in a couple weeks and get an approval. So what we're presenting here, we're going to plan to present something largely similar to this later in July with some additional attachments and obviously adding a little more detail as necessary based off conversation here. But I just wanted to give that as a preface to this. Adrian, if you can go down one slide. Brief agenda, we'll talk about the timeline and the plan. I want to cover some of the specific documents that we are asking for approval on. And then, a little information on some additional parties and processes that we're going through, and then some key risks. Next slide, Adrian. So on timeline and plan, what I have laid out here is what we're anticipating doing, of course, subject to some changes that I'll touch on. So the transaction board approval itself, we are targeting July EBCE board approval, as I just noted. This time it could get pushed to September. Obviously, we're on recess in August. Otherwise, we would push for August. I think what's important right now is we are trying to accelerate this process to be able to bring it to the board in July because markets have opened up. So as I've noted, I think in prior sessions, markets were not open. The interest rates were not optimal to have that taxable to tax exempt spread. And now markets are, and we are seeing other transactions pricing. And so we're eager to get out to market and make sure we take advantage of those optimal market conditions. SVCE is a co-participant in this, I think, as we're all aware. They're seeking board approval in July. They have recess, in August. They have recess currently in July. So they're just a little bit behind us, a few weeks. And so, obviously as a joint prepaid transaction, both CCAs, of course, need to get that authority and approval. We will also take this forward to the JPA that we formed a few months ago called the CCCFA. This is the issuing conduit that we formed in order to actually issue the bonds on our behalf. So in addition to our approval, you'll see we'll cover some documents. EBCE will sign some documents, and then the issuing conduit will sign some documents directly. So we will take forward to that board in the July or August timeframe. There is no recess for that board, so have a little bit more flexibility there. And then the last note here I wanted to communicate was, EBCE may move forward in this transaction to the extent there is any hiccup or hold up in the process for Silicon Valley. If we miss that meeting, there is a possibility that we would look to move forward on this transaction, even without SVCE, in light of any, basically take advantage of where the markets are if they were to hold that process up. So I wanted to flag that would be the intent. Note that MCE, which is in a totally separate prepaid transaction, they are moving forward with their prepaid transaction. And they will likely precede us to the market. They started their process a little bit before us, and they are actually working with a different financial party to execute on their transaction. So most likely, if we were to move forward without Silicon Valley, we would not be, sort of the first CC going out to market on this type of transaction. In terms of the bond raise and the initiation of the prepaid transaction itself, targeting that August to September timeframe. It could be later, just again, based off of completing documentation, dotting I's, crossing T's, and of course, market conditions. Though, as I noted, right now, the market conditions have been open, though they do tend to be volatile. So, just in the last couple of weeks, they said, unfortunately, rates are trending a little bit in the wrong direction. But obviously that can always revert. So I think for that reason, best to get enabled as soon as we can, and then we can kind of wait for the right moment in terms of market conditions to try to get bonds raised. Touching on factors that may impact timing. Again, I talked a lot about kind of market conditions, but really what we're looking at are spreads between taxable and tax exempt rates. Generally, an increase in interest rates means a more favorable environment for this type of a transaction. Yeah, and then the last point here, assignments and consents. Obviously necessary here is to have our power purchase agreements flow through the prepaid transaction itself. So just want to make sure that we are getting the appropriate assignments with our energy suppliers to be able to flow through this type of a transaction. We don't anticipate that to hold up this process, but again, they have to review documentation, sign off on it to allow that to flow through. And so there's a little bit of an educational process there, sometimes depending on the counterparty. Next slide, Adrian. So as I noted earlier, there are a certain set of documents that EBCE would sign directly, and then there are sets of documents that the issuer signs. This first page details the documents that EBCE signs. And so let me touch on each of these. The first is the power supply contract. That's probably the most kind of fundamental document to this transaction. And this is basically a 30-year energy purchase agreement between EBCE and the issuer. And again, as a reminder, the issuer is sort of the conduit vehicle that actually issues the bond. And the issuer actually signs a prepaid energy agreement with, in this case, Morgan Stanley. And then we sort of back to back that arrangement with an issuer to EBCE power supply contract. So this contract will mirror one of the documents on the following pages is the prepaid energy agreement. Those are the two most fundamental contracts to this whole arrangement. But this is the one that EBC is specifically a party to. The next one is an assignment agreement, and that is really the agreement that sort of stipulates and specifies our actual energy supplier, that contract, and how we assign that through this vehicle. As noted, we have a number of power agreements that are in place as is, and we'll continue, of course, to put in future power agreements in place as well, of course. And so the idea of this transaction is we're not, we are taking in existing contracts or contracts that we want to sign in the future and having those flow through the transaction and getting a discount on those transactions. So we do need to get approvals on assigning those contracts through this vehicle. Third is the project administration agreement. This is an agreement between EBCE, Silicon Valley, our joint participant, and then the CCCFA JPA. And this really just kind of lays out how we will work with one another, make sure that we are making mutual decisions on the prepaid transaction itself, and sort of speaks to the authority to EBC for EBC to sort of execute certain documents on behalf of the issuer. This is the two things I would highlight here. One is that EBC and Silicon Valley, as joint partners in this process, are making certain decisions together. But the one item I think is important to understand is the transaction itself does actually largely operate independently. So we'll go out with a bond raise, an entire bond raise that covers both of our parties' transactions. But the underlying document, such as the power supply contract, that is an independent document between us and the issuer. Silicon Valley would have their own transaction. So if there were any disruptions over the 30-year life of this transaction to one of the CCAs, it does not impact the other CCA. So we're not taking their credit risk or anything like that through our transaction. And then the fourth agreement here, really much more of an administrative document. This is a PPA payments custodial agreement. And this is between EBCE, Morgan Stanley, and a to-be selected custodian bank. And that custodian bank would really be responsible for flowing payments and managing payments that we are making to the issuer, and then ultimately going to Morgan Stanley, so that there is an objective third party that is custodian of those funds going in and out.
Howard, a quick question on the custodian bank. Are you looking at a bank within our region, I hope? Because I know that'll be a question that the board will be asking, I'm sure.
Absolutely, and we certainly know that is always the intent is to try to do as much locally as we can. In this case, it is a very specialized custodian bank, and working with our financial advisor, Morgan Stanley. Small local banks do not serve as bond custodians, generally speaking. Some of the big names that we are aware of that do these types of services are Wells Fargo, US Bank, Bank of New York. So they really tend to be large national banks. It's not obviously there are a variety of different types of custodial responsibilities. And for some of those, a local bank, a smaller bank, a regional bank would be very appropriate to call on them to do that. For a bond issuance, generally that really reduces the subset of those service providers. And for a something specific to a prepaid transaction, which is a very specialized financial transaction, you really shrink that universe to a small handful of banks, unfortunately.
Thanks, Howard.
With that said, we are soliciting that from a number of different parties, so not finalized. So to the extent there is an opportunity to do that, we will certainly look to do that.
Thank you.
Next slide, Adrian. The next page, this slide sort of sets out a number of documents that the JPA, the CCCFA signs directly, and EBC is not technically a party to. The first agreement I've already touched on, that's the prepaid agreement that mirrors the power supply contract that EBC is a party to, and that's between the prepaid supplier and the issuer. There's also the repricing agreement. As a reminder, for this transaction, even though it is a 30-year life, you actually re-raise bonds every 7 to 10 years, depending on kind of where market's at. And that's all based off of where the optimal taxable to tax-exempt spreads. And so by doing it and kind of reissuing bonds every 7 to 10 years, they find that the actual NPV value of the 30-year transaction tends to be higher than if you were to try to go out and raise a 30-year bond from day one. And so the repricing agreement lays out terms for how you go about reissuing those bonds and how you reset the discount and things like that. What's important that I'll highlight in that particular instance is that, when we, from the outset, when we initiate this transaction, there will be a discount, and we will set a minimum discount in order to target in order to actually move forward in the transaction. And I anticipate that to be around 10%. In the repricing phases, of course, if rates change, that discount can go up or it can go down. We will, in the repricing agreement, is where we establish a minimum discount. That is still subject to some level of negotiation. I anticipate that to be in the sort of 6 to 7% range as opposed to 10% range. So minimum discount is going to most likely be less than that 10% level. There's a little bit of commercial negotiation there, but generally that is set based off of a tax analysis to say you have to have a certain probability that you'll be able to hit that minimum discount for tax counsel to say that's appropriate. If you set that minimum discount too high, they believe that probability comes down. And right now they set that probability at 80%. So that's where that number comes in. As much as we like to negotiate that to be higher, we don't have a lot of flexibility in doing that. But that's where that's laid out in the repricing agreement.
And is that really to kind of give us kind of a certainty in terms of our anticipated savings over the 30-year period? So we're not dealing with huge fluctuations in terms of that discount. Is that really what kind of that intent is?
Yeah, I mean, the intent really is because we're working with this counterparty for 30 years. We want to make sure that we're locking ourselves in with as high of a discount as possible, understanding that market conditions can change. So while that establishes a minimum discount, we hope that it will be above that, and the higher the better. So not concerned with any volatility that would increase that above 10%. Of course, we would be very interested in seeing that. Optimizing that. It sets a floor for us. That doesn't mean that there's no chance it can go below that floor. If market conditions, unfortunately, were very unfavorable, it is possible it would be below there, but we would not be obligated to move forward with the transaction in that instance.
Okay.
And so that's the benefit. So
we could bow out at that time.
Exactly. It is likely that even if it came in below that minimum discount, we would say, move forward with it. Some discount is better than no discount. In no case would that be below zero. So again, if it's 4%, that may not be as high as we'd like it to be, but 4% is better than 0%. So there's a good chance we'd still want to move forward with it, but there's no obligation for us to.
Perfect.
Alternatively, if it's above that minimum discount, there is an obligation for us to move forward, and we do need to sort of stick with the transaction. Moving forward in these documents, there's the trust indenture. Of course, that is a very critical document here related to the actual bond issuance and the bond documents themselves. Again, the issuing conduit is the one that signs that because they are actually issuing the bonds. There are a bunch of commodity swap agreements that switch from fixed to floating within the transaction. Those don't have a material commercial impact on the overall transaction, but because you have to size it over a 30-year transaction, assuming certain cash flows and certain energy prices, you want these swaps in place to give us a certainty of what the kind of value and discount is that we'll get through the transaction. There is a parent guarantee that Morgan Stanley actually provides for the transaction itself to sort of de-risk that. So that's something that Morgan Stanley ultimately signs with the issuer. And then there's the front-end custodial agreement. This is similar to what I described with our own custodial agreement managing our PPA payments. There are, of course, other cash flows flowing through. So between the issuer, between Morgan Stanley, the actual prepaid provider, and the bond trustee, there's actually a more important custodial agreement, I should say, that piece of it is really critical because the bond debt service obligations flow through that custodial agreement. So that's that's the set of documents that the CCCFA signs. When we bring this to the board, our intention is to bring forward all the documents that that EBCE signs, of course, in as near a form to execution as possible. And so those are the forms in the prior page. And then we will provide most of these documents, not necessarily every single document, because there's about 20 documents associated with the transaction. Some of them are pretty light, pretty ministerial documents, but the critical documents, the prepaid agreement, the repricing agreement, the preliminary offering statement, which is related to the bond offer. Those are documents that we will provide to the board in July as informational because we are not the actual signing entity. There isn't a need to explicitly have you approve it, but obviously we want to make sure there's transparency and we are sharing those documents to you. That they are, as a heads up, they are fairly dense documents, as you'll see, but they are fairly template and boilerplate, as most bond documents tend to be in the prepaid space. Next slide, Adrian. This one I briefly touched on, the preliminary offering statement. This really is a document that markets the bond sale overall to potential bond investors. And so this will summarize a lot of the underlying transactions and such. I would point your attention to this document probably more than others because this is seen as it is still a pretty dense document, but it is a good summary document. And will help to sort of capture all elements of the transaction, since this is what will be utilized for the bond investors as well. It's called the preliminary offering statement because it is preliminary. It'll be subject to some changes. Ultimately, when we go out for the actual bond raise in that August-September timeframe, it'll be an offering statement. It'll be baked. It'll be exactly what the bondholders will sign on to. Next slide, Adrian. These are just a few additional counterparties I want to sort of flag that we're in the process of closing on. We've touched on the custodian already. There is a solicitation process that our financial advisor, PFM, is managing right now to select that provider, hoping to finalize that in the next couple of weeks. There's a commodity swap counterparty. This is something that Morgan Stanley, as our prepaid provider, they provide. They've issued a solicitation there. So, in the process of selecting that provider as well. And the third one is a credit rating agency. This is a rating specifically on the bonds, not on EBCE. So as is typical for most bond raises, you would get a rating on the bond itself in the transaction. And so that process is just getting initiated. You really want all of your documents to be pretty well baked and done before you go to the credit rating agency. So it's a little bit early at this stage to really select that counterparty. But as you probably all are aware, there's really only a small select group of sort of large rating agencies that would be appropriate for this this responsibility. Next slide. And this is the last slide. This is just general key risks, and a number of these things we have highlighted in the past, but just want to continue to make sure that these are front and center. If this transaction does not materialize for some reason over the next month or two, market conditions don't present themselves as we anticipate they will, our out-of-pocket expenses are fairly de minimis relative to all of the advisory and counsel fees that we have as part of the transaction, since this is fee contingent. The second bullet, this is really the bullet that I focus on from a risk perspective. We're really locking ourselves into this transaction, at least for the amount of megawatt hours that would flow through this transaction. And the risk is that there may be a better transaction that comes out in 5 years or 10 years that could better optimize tax structures and increase that discount. I don't anticipate that. Obviously, tax code is not something that just changes overnight. It takes some time to do that. This type of prepaid transaction has been done for decades. But that is largely the risk that I look at, is the opportunity costs. We're not going to lose money through this because the discount goes below 0% or anything like that. It's just whether there's a better mousetrap that's embedded in the future. As I noted before, I think that's a low risk because we have a lot of power we need to buy. So if a better thing comes out in 5 years, we're going to have more power that will flow through that one anyways. And the idea that we would have all of our power already flowing through a less optimal tax structure is pretty unlikely. You'd have to move very quickly, very aggressively to try to get all of these through prepaid transactions over the next few years. So I think that's a low risk, but I do want to make sure that is well understood. That is a risk. There could be something better out there. We're obviously always trying to optimize. The next few risks I really think are very, very low probability risks, but there are risks nonetheless. One is if there's a load loss, right? If we EBCE have a load loss, we may not have the megawatts necessary to flow through a transaction like this. By and large, that risk is really to Morgan Stanley, right? That means that they've received a bunch of funds through the bond raise. We have the load loss. They have to collapse the transaction in the future. They have to return those funds. It's not really a huge risk to us, but it is obviously, one that Morgan Stanley is very acutely aware of and wants to make sure that we are doing everything we can to assign necessary PPAs through the transaction and make sure the necessary megawatt hours are flowing through and everything. Regulatory risks, this is one I've definitely mentioned in the past, but our PPAs satisfy certain compliance obligations, being PCC1 bundled RECs, having SB 350 qualifications. There could be future regulatory compliance obligations. To the extent that the CPUC took a view that because we floated through a prepaid transaction, that somehow disqualified the compliance, characteristics of it, that is a risk we bear. We have had meetings with the CPUC. MCE has had extensive meetings with the CPUC. We do not believe this to be an extensive risk. They're never willing to sign off on something and say, on the outset, you have zero risk here. We've opined on this, but we have discussed it with them. They have flagged no material concerns. They said, we'll review the contracts when you send it through. We reviewed it with our outside procurement counsel and extensively with our counsel related to prepay. So we don't believe that is a material risk in any way. And we are negotiating rights to be able to terminate those assignments to the extent that there is a regulatory risk that is encountered. So I think it's well addressed, but I want to make sure that we do highlight that. And then the last one is just general political risk, right? I mean, this is a sort of a tax arbitrage transaction. If this collapses, reputational risk, things like that. Again, I don't think that's on us. Largely, that's on Morgan Stanley. But we would be associated with the transaction if there were any disputes or anything like that. We want to be aware of that. And that is it for this presentation. As always, I know it's a dense presentation. Happy to take any questions here, but we will also present something very similar in the July board meeting for additional follow-ups as well.
Thanks, Howard. I'll look to the attendees to see if there's any questions from any of the attendees. I'm not seeing any hands raised at the present time, so I'll turn to my fellow board members and open it up for questions or comments. Howard, the only question I have is that, do you have an anticipated savings amount to our organization based on, let's say, a hypothetical 10% discount? Can you translate that into what that dollar amount would be to the organization on an annual basis?
Yeah, I did highlight in a prior presentation. Apologies, didn't put it in here, but I will add it to the full board meeting when we bring it forward. We anticipate this to be somewhere in the $1.5 to $3 million annual savings range. So, it's not a huge number. The idea is that we would replicate this type of transaction and continue to flow more power through future issuances of this nature and hopefully increase that in the future to, $5, $10, $15, $20 million with enough of these transactions. And that certainly is very material. But we intentionally wanted to split this with Silicon Valley since it's our first transaction and just make sure we're de-risking as much as possible. And so it tends to be on the smaller side of things. The ultimate bond raise itself is really hard to predict. If we're at the high end of what we think is the feasible range, that's where it could be around that $3 million mark. I think it's probably going to be more like $1.5 million to maybe $2 million, just reasonable projections based off of kind of bond market appetite for these types of transactions when you do a single transaction. But it's really hard to say. We've asked Morgan Stanley that until you really go out to market with an offering statement and get that investor interest and actually run an auction, you won't have that number. So for July, we are going to ask for authority most likely for a transaction size that is about $1.5 billion in overall bond proceeds. Half of that would be EBC, half of that would be Silicon Valley. And so if we were to hit that max level, that would be about $750 million. That would be for covering a 30-year transaction, bear in mind. That's a big sounding number, but it's a 30-year transaction. So what we're really flowing power through is in the sort of low tens to millions of dollars, depending on how that size is.
And would you envision, as a follow-up to that, Howard, would you envision, as we see increased savings to the organization, that we might be able to pass on some of those savings to our customers so that they see, that not only are we managing the electrical grid in terms of renewable energy, things of that nature, but we're also now able to provide them with a discount based on our good management of our finances?
That's a great question, and it's been asked before. The way I see that is this is a way for us to manage our energy expenses. And uniquely, we can do this, whereas IOUs can't, of course, because they're not tax-exempt entities, right? So this allows us to really stand apart and be competitive relative to an IOU from a structural advantage perspective. I don't think it makes sense to say, oh, we got this much discount from this transaction, so we will dollar for dollar earmark this to some energy product that we're providing to a residential or commercial customer. The way we see it as just as we try to manage down our energy costs through good, sound, procurement policies, this is a really good tool to help us bring down our energy procurement costs. And that, of course, ultimately, everything gets passed on to customers at the end of the day, right? That is a board decision with overall energy cost savings. Does that mean a higher discount to customers? Does that mean more local program dollars? Does it mean higher renewables content? That is for the board to really help us decide how we manage our overall budget. But this gives us more headroom to operate, of course.
Excellent. Kathy? You're on mute, Kathy.
Sorry. What happens if an energy provider defaults, goes bankrupt, in some is not able to deliver the energy? What's the risk, or how would something like that work or be handled?
Yeah, it's a great question. The first thing I would say is, that is technically a risk that we face regardless of this prepaid transaction, right? We signed a 20-year PPA for a solar project. We expect that project to perform. We work with very reputable, experienced developers to build that project. They ultimately secure that through a security posting of some form, either a parent level guarantee, a letter of credit, or cash. And that is that's really our protection that project operates over the life of that PPA. All of our PPA contracts are signed with project companies that are not capitalized, and that is throughout the energy industry nationally. That's how these transactions are managed. So that risk is there. We have security, millions of dollars of security standing behind it to ensure that solar project or that wind project performs. And we, of course, have an asset manager and certain requirements in our PPA contracts that ensure that those projects are managed by experienced, large energy portfolio owners. As it relates to the prepaid transaction, there's an obligation that power flows through there and comes back to us, right? And so if a PPA defaults for some reason and can't deliver, the most obvious thing that we would do is we would assign a different PPA through there, right? So same megawatt hours would flow through. This PPA goes down. We have, right now we have about 6 PPAs signed. We're going to bring a few more to the board. We'll have 10, 12, 15 PPAs that we can flow through this thing in the future. So we'll probably just swap it. To the extent that there's some real outsized risk that for some reason we can't get a PPA in there, there are various mechanisms in this transaction that allow us to remediate that through other transactions that if we're not able to actually assign it in, we have other EPS qualified energy that we're still procuring, of course, because we're still serving load that we can use to remediate the transaction. And basically nothing really bad happens. We still get the discount. And then there's that outside risk is for some reason our load drops or we simply can't get a PPA through. We weren't reasonable with how we managed that. And tax counsel says, well, you can't get the benefit of that discount then. You're not actually trying to get any energy through there. Then Morgan Stanley would be forced to basically remarket that energy to an outside qualified buyer separate from us. And so there certainly is a risk there, but really that's just opportunity cost again, right? I mean, if we're not flowing megawatts through, we're not going to get the benefit and discount of that at the end of the day.
So if an energy supplier, let's say, can't deliver and you go and you assign it, but isn't there some risk that it could be assigned to a higher cost of the energy so that the benefit of the discount wouldn't be there?
No, that would not be a risk. Again, what flows through there is only what we put through there. So if we put it through there, there will be a discount applied to it and then we'll get it. If there's a default on one of our contracts and they can't perform or deliver, it wouldn't flow through there. And therefore we wouldn't get the associated discount with that energy flowing through. So yeah, I mean, yes, we would have higher energy costs because we wouldn't be getting the discount, but that wouldn't be any different than if we didn't have the prepaid transaction, quite frankly. We'd still have to go find other sources of energy that we'd have to procure in that instance.
But it's a risk in terms of if you're looking for the savings to do whatever, and they, company ABC doesn't perform, and you go out to company DEF, and they cost 10% more. We've lost that savings or that extra funding for whatever we had chosen.
That's right. I mean, if we are earmarking that savings that we're getting towards something and suddenly we lose that savings, then that's a fair point. I mean, that's a risk. We have to manage that within the budget. And part of the reason, my earlier point to Director Handon is, would be cautious to say dollar for dollar, we're going to go
Right.
transfer that to a customer of some sort. We really want to be prudent with saying that's an overall energy, management tool. And like any other energy management tool, that may be in place. There's some risk of that performing. We wouldn't be worse off without it. Not a reason not to do this transaction, but it does mean that we should be prudent with how we earmark those savings and how we utilize those savings.
Okay, thank you. And that's kind of what I was getting to. You don't want to spend it necessarily until you've actually put it in the bank.
Absolutely. Absolutely.
Okay. All right. Thank you.
Any other questions from any board members or attendees? Seeing none. Thank you, Howard. Let's move on to item 6, 2020 RPS and Storage Resource RFO.
Great. Now there are 2 more items, 6 and 7, this one and then a building purchase sort of topic. And I know we started late. We have just about 40 minutes left in this session. So I will try to move quickly through these last 2 items to get them both in. If you want me to change the pace in any way, please direct me and let me know.
Yeah, and Howard, I think we were all in attendance for the building purchase discussion, I think. So I think we could probably narrow the conversation there since we've already authorized the staff to move forward on that purchase agreement. So
Okay.
I'll leave that up to your discretion.
Yeah, that makes complete sense. I will spend more time on this and very little time needs to be spent on that one. I think there's a little bit on the financing specific item, so I do want to cover it, but I don't think it's too extensive. Great. Adrian, if you can go to the next slide, please. So, as a reminder, in the June board meeting, we brought forward 2 standalone storage projects to get authorized on, and we presented some of these materials. Those 2 projects came out of our most recent energy and storage RFO. What I'm presenting here is a further update to that. Again, the background materials on the RFO are the same. What we're looking to do is bring forward 4 additional projects to get authorization to execute on. For the FAT meeting, of course, this is purely informational. We will bring forward in July an action item and seek formal board approval on executing those contracts, but wanted to preview them here. This will largely look the same in the July board meeting for presentation. So I'll cover the first few slides relatively quickly since you have seen this before, but I think refreshing is always a good thing. This RFO's intent was really to secure additional long-term PPAs with renewable energy and storage contracts to add on to our existing portfolio. That was addressing things like SB 350 requirements, which is a long-term contracting requirement, our IRP incremental RA obligations, our general procurement needs. We obviously looked at a number of project-related characteristics related to where was the project located, the construction status, and the development risk associated with that project. Capacity size, online dates, contract durations, technology types, and ultimately we issued an open competitive RFO, evaluated those, and now we are at the tail end of that process in terms of bringing projects forward to the board. Next slide, please. We saw a fairly robust set of proposals that came in through that RFO, which is great. Development pipelines are healthy in California. Saw about 70 unique project sites, over 400 contract variations. All of the product types that we solicited were offered. Obviously, some more than others. Offers included solar, wind, geothermal, hydro storage. You can imagine that sort of, we saw the most solar and storage offers in wind, geothermal, hydro. There's a lot less of that in state, but fortunately we did see offers there. And then predominantly projects were in California, but we did see a number of projects outside of California in the surrounding areas covering 6 different states. Next slide, Adrian. A little bit on the evaluation process. When we evaluated proposals, we looked at the counterparty execution risk, offer competitiveness, that is largely focused on pricing and NPV evaluation, which I'll touch on in a little bit, and then project development status. So, making sure we understood what is the probability that this project can get built in the coming years and can come online in a timely manner. We had 2 reviewers on every single project, so we had redundancy. And given the number of proposals, as we just touched on, this was quite a heavy lift to go through that process. And then we looked at all of the scores. We looked at term sheet markups. We looked at the NPV, and we did an overall weighting of those scores. There were a number of different line items in our sort of scoring rubric. Maybe the thing that I'll touch on here in terms of NPV scores is the hardest thing about this evaluation process always on the NPV calculation. We do the best job we can in terms of looking at forward price curves with energy costs. We look at a variety of scenarios. We sort of stress test that pricing. We do not have a crystal ball, of course, to predict future energy prices on an hour-to-hourly basis. So, that is the fundamental risk that we really face. Is we see a project as accretive to our organization, being NPV positive, and energy markets change and they adapt. You see congestion in certain areas. You see an overload of solar in certain areas, and that has an impact on potential values of some of the projects we're looking at. We try to stress test that, and what we've detailed here is how we do that with a number of different curves, and we weight towards the downside. So we take a somewhat risk conservative approach and say, we'll look at the P5 results and we weight that 50%. We'll look at P50 and P95 results and weigh that 25%. And then we do an average of that across 3 different curves. So there's a number of different data points that we weight into an NPV number. That number ultimately has a 45% weighting in our overall scoring rubric. So very significant, but obviously there are a number of other factors related to location, use of union labor, counterparty experience, things like that, that we ultimately boil down into our overall process to select our shortlisted counterparties that we're moving forward with. And this, lastly, the rubric here that we use is consistent with what we did in 2018 as well. Next slide. This is a little bit redundant, but I just wanted to highlight this in that there's a number of factors when we make decisions on number of megawatts to move forward with, types of technology to move forward with. There's the pure financial analysis of whether we think this is accretive to our finances, but there are also compliance aspects, right? And so this is important that we are we are abiding by the SB 350 requirements, which requires us to have a certain number of contracts under long-term PPAs, 65% of our RPS obligation. There's SB 100, of course, which is the RPS obligation that steps up through 2045. We have our own EBCE board adopted targets of 100% carbon free by 2030. So we need to, of course, step that up. We need to procure pretty aggressively. But we also want to cost average over time and make sure we're not concentrating all of our procurement risk to one period of time and take too much technology risk there. The one thing I will highlight here that I think is important is PCIA Working Group 3. This is an important factor because PG&E has a long renewables position. And we are largely paying for much of those resources through the PCIA. And so Working Group 3 speaks to how PG&E has to sort of offload some of that long position to other load serving entities, such as ourselves as one of the parties that pays for the PCIA. There's a lot of different market mechanisms of how that will get priced, whether we want to take those volumes or whether we don't. And there is risk, that we would be well over procured and take the costs associated with that if we were to procure too much outside of that and then take large volumes from Working Group 3. So I won't go down that rabbit hole of those details because some of them are not finalized yet. But I do want to just make sure to flag that there are some pretty big fundamental risks that we have to weigh when we say we want to go procure from 3 renewable projects. Well, what if there's a better price that can be offered through this Working Group 3 process? How do we balance that risk and secure the assets we need today and not know exactly what's going to come down the pipeline in the next 12 to 24 months?
Howard, my only quick question on that is, do we have a time period where we have to make an offer on those IOU long-term renewables with PG&E? Do we have a time limit on that?
It's not finalized. I would anticipate that in early 2022 timeframe, that will probably go out. So my expectation, there's already been a proposed decision on that, even a finalized decision on that, but the final decision doesn't include all the details of how this sort of auction process works. It just says that they have to do it and the time frame. So that's been issued. I think by the end of this year, the details and the rules will probably come out. And then 2022 will be the actual auction process and the contract negotiation process. And 2023 is when that would actually flow. So, we'll be gathering more and more information as time moves forward here. And that's kind of how I would anticipate it to happen.
Thank you.
Next slide, Adrian. This is the interesting stuff. Now here, the summary of the 4 projects that we plan to bring forward. There is a 10-year, 100 megawatt wind project based in New Mexico with Pattern Energy, expected to come online in December of 2021. There's a 12-year, 47 megawatt, 4-hour duration, so times 4 is 188 megawatt hours. Battery project in Kern County, California with Terragen. We have signed with Terragen in the past, as a reminder. That is expected to come online in June 2022. There's a 15-year, 50 megawatt solar project, solar and storage project with a 12.5 megawatt battery, times 4, so 50 megawatt hour battery in San Bernardino County with Clearway, and we have signed with them in the past as well. That's expected in March 2023. And then lastly, there's a 15-year, 125 megawatt solar plus 125 megawatt RA battery project in Riverside County in California with Intersect. We have also signed with them in the past. That is expected to be operational in December of 2022. That last project is an indexed project, index rec project plus RA, a little different from some of the other contracts that we have signed on a long-term basis, where we typically take the energy component and use that as an energy hedge. Because we have a lot of concentration in solar and solar plus storage, one of the things I've talked about is contract diversification. So that last contract is a good example of how we want to diversify contracts, is do an index contract separate from some of the bundled energy fixed price contracts as well. Next slide. So the next few slides are all detailing these transactions in a little bit more depth. So, the Pattern Wind project is a 100 megawatt project. It's part of a larger build out, which is 272 megawatts, which is part of an even bigger build out, which is about a gigawatt. So this is a really large New Mexico wind facility that Pattern is building. It's already started construction, of course, well ahead of this contract. It is expected to come online at the end of this year, which is one of the reasons why we really favored this. Also, this being a wind project is good to help further diversify our portfolio, which is really solar heavy. They have committed to invest in our community investment fund. They are utilizing a mix of union and non-union labor and at prevailing wages in New Mexico. I do want to be upfront saying this is New Mexico, so while all of our projects in California fully utilize union labor and tend to sign five-party PLAs, project labor agreements. This project being in New Mexico, very, very difficult environment there with a gigawatt wind project build out, far more limited labor availability. And so, and quite frankly, this project already being partially built, we did not have the ability to sort of negotiate some of the typical union labor requirements that we have. But in New Mexico, I think what they have really emphasized is these are really good, well-paying jobs in New Mexico in areas that typically don't have the availability of these types of jobs. So it is a positive for the work environment there. Next slide, please. A little bit about Pattern itself. Pattern is a very large international wind developer specifically. They also do solar assets. They were founded in 2009. They have 4.4 gigawatts of operating capacity currently throughout US, Canada, and Japan. They have a pretty strong track record in California and have signed contracts with CCAs as well. You can see a sampling of that. The one I'll highlight is the Dern Mesa Wind Project in New Mexico with Silicon Valley and CCC. So they signed a 200 megawatt project in this same area. So similar to our contract. Next slide, please. TerraGen, this is the standalone storage project. It's a 47 megawatt standalone storage project at a 4-hour duration. 12-year project, expected to come online in June of 2022. One unique aspect of this that I'll highlight is there's some risk that from an interconnection perspective, this project could get delayed into November. And that's material for us given our incremental RA requirements that are in the summer months. And so we have negotiated with them an ability for them to backfill RA to the extent the project is delayed later in the year, that they will deliver RA as a substitute for us for the August timeframe, which is our critical requirement that the CPUC has ordered. So I think we've managed that risk pretty effectively. This is pretty unique. I found this pretty favorable. Other than that, they have similarly agreed to invest in our community investment agreement and investment fund, and they have already executed a project labor agreement. Next slide. TerraGen, again, we have executed a contract with them already. They are a very experienced developer from a solar and wind perspective. They were acquired by Energy Capital Partners, a large private equity firm, in September of 2015. That is who owns them. They have a large portfolio of operating assets, about 1 gigawatt. And you can see here a sampling of CCAs that they've worked with, quite a number of them, obviously EBC included, but also MCE, CPA, Clean Power SF, San Jose, Pioneer. So good CCA experience. Next slide. The next one is a project with Clearway Energy. This is the 50 megawatt solar plus 12.5 megawatt storage project called Daggett. This is part of a larger project build out of 482 megawatts. It's a 15-year term with an anticipated COD date of March 1st, 2023. Project has, they've agreed to investing in the community investment fund. They've also signed a letter of intent to execute a 5-trade PLA. So they are anticipating starting construction soon. So they have made that same commitment that we typically see for California-based projects. Next slide, Adrian. Clearway is a well-capitalized large solar developer. They have offices in San Francisco, so in the Bay Area. They have quite a sizable portfolio of operating assets, about 5 gigawatts of renewables across 26 states, and have a significant pipeline of development assets at 10 gigawatts. We have a signed contract with them, as I've already noted. They also have signed contracts with CPA in the past, so they have some CCA experience. This, of course, would be a second contract that we would put in place with them in terms of a long-term renewable contract. Last project here, Intersect. This is 125 megawatt solar PV plus this is actually a typo. Apologies for that. This is 125 megawatt battery storage, and this is part of a larger build out. Like many of the other projects, this is a 500 megawatt PV plus storage project. We're looking at a 15-year contract. As I noted, this would be an indexed deal, and then we're doing a 10-year RA contract with it. And expected COD is December 31st, 2023. The full capacity deliverability is in 2021. That means it is qualified for resource adequacy. They have agreed to invest in the community investment fund. They are in the process of signing a PLA. And, typical at this stage, given that it's a couple years out, is not to have that signed yet, but they have committed to that. And so we are in process of completing negotiations with them. Next slide. And just a little bit more about Intersect Power. They are a joint venture between SoftBank Energy and Intersect Power. They have successfully developed and permitted 1.7 gigawatt portfolio with 250 megawatt projects across California and Texas. They're a 22-person company with a lot of actual individuals based in Alameda County and in the Greater Bay Area, so a bit of a local developer. And they have experience, obviously, with EBCE, given our RA-only contract. They also have a contract with Clean Power SF. Actually, it's not listed here. And you can see some of the other load-serving entities that they have contracted with as well. Next slide. Here's just a map of the 4 projects that we were talking about here in color here. So you can see the 3 in Southern California and the 1 in New Mexico. The gray projects are ones that we have existing. So you can see this does, give us a little bit more geographic diversity. We will, of course, in the future, once we have contracts finalized, we'll bring a more holistic, comprehensive picture of what we end up signing, since we need to complete these negotiations and actually execute these contracts. So give you a more holistic view of what the portfolio actually looks like when everything is done in the coming months. I think I've touched on everything else here, so I won't belabor some of these additional points. Next slide, Adrian. This is just a refresher of the contracts that we already have signed, and these were signed out of our initial RFO. So a mix of solar, wind, solar plus storage projects. I think, as you were all heard earlier on our special meeting, our wind project, our in-county, Alameda County wind project, just came online in the last week. So really excited about, 1, our first wind project, but 2, of course, our first in-county project. That has begun to deliver energy is a big milestone. So we'll be having a ribbon cutting ceremony, I think, in the coming months, and make sure all the board members are invited for that event. But that has come online. So the top 2 projects are currently delivering energy, and then the bottom 4, those are still in the development and moving into the construction phase soon. Last slide here. Next steps, looking to complete negotiations, of course, for all of these projects and execute those contracts. We will bring an informational item to the board in the future once all of these are done and executed, so you get a holistic view of the portfolio, and continue to keep updated on project development and construction milestones. Look at various CPUC filing requirements, and of course, keep a very close eye on the IRP process, where we have to establish our RA procurements and general renewable procurements to provide that visibility to the CPUC for planning purposes. That is it in a nutshell. Again, we plan to bring forward this exact item in July to the full board, but happy to take any questions now.
Great. I'll look to the attendees to see if there's any questions from the attendees. And I see Jim Lutz. Jim, Adrian, he has a question or comment?
Great. Yes, I'll recognize him for 3 minutes. Hold on 1 second. Jim Lutz, you're recognized for 3 minutes.
Thank you. Thank you. And Howard, that's a nice detailed, or not detailed, but a good overview of the 4 projects. A couple questions. None of those projects are local? Were any of the responses to the RFO located in EBCE territory? And how did the weighting rubric account for the local benefits for how heavily weighted were local benefits? And my second question is, because these projects are remote, how does transmission cost and or the various risks from, say, congestion, wildfire, or earthquake fit into the considerations on how these projects were ranked? So those are my 2 main questions. Thank you.
Chair, I'm happy to answer those, or I'm happy to get other questions from other.
No, Howard, let's go ahead and answer them as they come in. Thank you, Jim, for your questions.
Sure. In terms of the local aspect, one, I want to preface that we are still in ongoing negotiations with certain counterparties, so we have not closed out the RFO. So I'm going to limit my detail and commentary on that, but I will say that we did have local projects submitted into the RFO. Obviously, relative to the overall magnitude of proposals that we received, obviously the vast majority were not local, but we did consider. We are still discussing projects there, so sort of pending. And we did weight specifically to local. Forgive me, I don't have the exact number off the top of my head, but there was a weighting specifically to project location, developer headquarter location, and then labor location, and all of those aspects, ends up giving a fairly material weighting towards a local aspect of the project. I want to say it's sort of in the 5 to 10% ish range. I'd have to revalidate that, but order of magnitude, that's about right.
Thank you, Howard. I'll look to other attendees for questions or comments. Seeing none, I'll go to the board members. Questions or comments? Howard, I just have a couple quick questions. If you could go back to slide 16, and this is really just a general question, Howard, because I'm, as Kathy knows, new to this board, and some of the terminology that's used, I just want to kind of have it in magnitude in my mind. So let me use Clearway, for example, where the megawatts is 112. Now, is that 112 megawatts that they will be delivering to us per day, per year? Help me understand that.
Yeah, it's a great question. So let me help translate that. That is the overall capacity, AC capacity of the project itself. So that means at any given hour, if you were to maximize the amount of solar that could possibly be produced, it would be 112 megawatts. Obviously, as you are all well aware, the capacity factor on a renewable project, a solar project, is not anywhere near 100%. So it doesn't deliver every hour of the day. My general rule of thumb is a 100 megawatt project delivers about 250,000 megawatt hours a year. So our entity with the new jurisdictions that have recently joined, we're about 7 terawatt hours of energy a year. That's 7, I always get my units wrong, 7 billion megawatt hours.
Okay. Okay, that helps me keep it in perspective.
So 250,000 megawatt hours out of 7 billion. Any one project doesn't have too material of a concentration, but we do try to limit it to, there isn't an official threshold, but we try to limit it to no bigger than like 150 megawatts for in terms of concentration to any one project performing.
And as we as we enter into these agreements, we're nowhere close to where we're able to, on our own, provide the power necessary to serve our customers. We're relying, I would imagine, on those PG&E contracts to provide a substantial amount of that energy. Is that correct?
Yeah, I think, this, I don't have the number off the top of my head, but, with these projects, if we assumed all of them were online, we're talking about order of magnitude wise, I want to say around 15-20% of our energy needs. So what, with the additional projects that we have layered in here, ballpark doubles that ish, maybe a little less. And so, substantive, but we're talking about 30 to 50% overall of our energy needs being hedged. And so we need to continue to procure additional energy for sure.
And our goal, I would imagine, Howard, at the end of the day, is to be able to have 100% capacity to provide energy to our customer base on our own.
Well, I don't think that's a very straightforward answer, right? It is, these are hedges at the end of the day. These projects all deliver to the CAISO grid, and then ultimately we buy from the CAISO grid. That's how the energy markets in California operate, or at least in CAISO operate, I should say. So I don't think we have an intent to say we want to hedge 100% of the energy through long-term contracts. I think we want to have some ability to do some short-term contracts. I think we want to have some exposure to the market. That's not, so we're nowhere near those levels to have to contemplate that too seriously. But in our IRP and such, we don't lay out a roadmap to say we will be 100% hedged with long-term contracts. I think there is risk to doing that for a variety of reasons. One of which is because PCI is in place. So technically, whether we take resources from the PCI through this working through process or not, we have certain hedges in place through that process that we want to be very conscious of what we want to layer on top of that. That's one factor. The other is just from a general risk management perspective, most entities going into a specific period of time have targeted being the 80 to 90% hedge level. So you still always have a little bit of market exposure. Just like you would manage your own retirement plan, you're going to diversify the types of resources. You want some of it riding in the market, some of it in cash, some of it hedged. So I don't think the intent is to be 100% under contract per se.
Thank you. My last comment. We have thousands of residents in Newark that were recently experiencing blackouts as a result of the inability for energy to be delivered to our area. I think this was about a month ago. And that's what I'm worried about. At some point, will we ultimately have control over ensuring that our customers are receiving energy 24 hours, 7 days a week?
So that is, of course, a concern, and there's always a risk there that we're always looking to manage. Right now, there is more discussion on reliability risk than ever. And so I guess two ways to answer that. One is, of course, that is very top of mind. We are thinking about bringing new resource adequacy online. That's part of what the IRP, the CPUC's specific order was recently, to say load serving entities have to go procure more megawatts of incremental RA. And so we have that obligation. That's a very specific requirement we have to make sure we're addressing and bringing online. We, of course, have that concern regardless of that specific obligation out there. That's in part why we're looking to develop new resources, trying to do that locally, trying to do more behind the meter resources and distributed resources so we can sort of spread that risk around. I think of the projects that we're bringing forth here, getting new generating capacity online helps to de-risk. Getting more resource adequacy online helps to de-risk. Getting specifically storage online helps to de-risk. A lot of the renewable generation, unfortunately, doesn't deliver at hours where we have the greatest demand in evening ramp hours. So that storage really helps. Locationally, it's important to consider as well. And I think where we've, of course, cited these projects, it's a combination of geographic diversity for our own portfolio from a financial perspective. It is thinking about congestion risk and how these assets will perform. But obviously, a lot of these are utility scale and they're not necessarily close to our load. They're in Southern California, outside of California. Bringing more capacity helps to de-risk things. If you can cite it in territory, that helps to de-risk things as well. At the end of the day, we are procuring from CAISO. So it's one grid.
Sure.
So there's a lot of regional and sort of broader dynamics that you always have to manage with how you cite those assets. We're going to continue to manage that. We are looking at kind of local resources as well to help from a resiliency and reliability perspective. And I think this does support that, but this is obviously not a single solution when it comes to reliability.
And my last comment as it relates to New Mexico and the fact that they will have some labor that's not union, that may be of concern to some of our board members. if they're able to hire non-union labor that are underserved within their communities, or offering opportunities to those that are underserved in their communities, and you mentioned they're paying top wages, I think that would be something that would be of certainly interest to at least temper that that situation. Something you might want to consider in terms of when you bring this to the board.
Understood. Yes, and they did highlight to me the prevailing wages that they pay, and obviously, so that speaks to that point, of course.
Perfect. Thank you. Any other questions from board members? Seeing none, let's go ahead and move on to building purchase, which I think we all had a briefing on this earlier. So this is the building purchase, Howard.
Yeah, I'll keep this short given the timing here of only about 5 minutes left. There's only a few slides. This is specifically focused on the financing piece, given the focus of this subcommittee. If you can go ahead and go to the next slide, Adrian. I think as Nick talked about in the earlier meeting, this is just kind of laying it out in a little bit more detail. We're in the process of negotiating a purchase agreement for real estate in downtown Oakland. These are the three financing options I really see as feasible. There's a conventional mortgage, as very traditional relative to what you may be familiar with from a home mortgage perspective, but doing it at a commercial scale. The more likely options, the real options that we're focused on, is a cash purchase and then a refinance. And so you can do a refinance with a conventional mortgage, or you can do a refinance with a lease back. And what Nick talked about a little bit before was that there are advantages of each of them potentially. We're still evaluating some of those advantages, or disadvantages for that matter. A conventional mortgage may have some limitations for public financing. There may be some explicit, or there may be some that may not have a strict limitation from a statute perspective, but may be less advantageous. For example, through a conventional mortgage, a bank may be able to take security in your loan and therefore seize an asset to the extent we did not perform on the loan. And so I think there is perhaps a preference to a lease back where the bank would not actually seize the building. They would just have a right to sublet that building. And so as a public asset, I think there seemed to be some advantage to doing a lease back for that reason, as opposed to, say, a conventional mortgage where they actually take a lien on the building. So we are evaluating some of those pros and cons. We're also, in addition, we're negotiating an amendment on an existing credit facility with Barclays Bank. That's a fairly sizable facility we put in place a number of years ago. We don't have any debt actually drawn in there, but there is an explicit restriction on taking on additional debt. So we do need to do an amendment of that facility in order to put in place, a building finance agreement. We have already been discussing that with them. They're very open to it. They want to work with us on that, but need to work through the details of, what kind of security the bank would look to take, and that may have some aspects related to whether it's a lease back or conventional mortgage that would be important for them. I think we'll probably close on the building in the August timeframe is what I would expect, with an initial cash purchase, and then do a refinancing probably in that October, December timeframe is my expectation. Next slide. The next few slides really touch on each of these options. I don't think I need to belabor this. This is really just detailing what a conventional mortgage sort of looks like. The next page, Adrian, I'll jump to that. This details sort of the cash purchase with a conventional refinancing. Again, this is one of the alternatives we're considering versus refinancing with a lease back. Last slide, Adrian. So this is some detail on the lease back structure itself. What I want to touch on is the building acquisition is not contingent on a financing, as we mentioned before. While we after we close on a cash purchase and we further evaluate these specific refinancing options, the lease back may be a better security structure, and is also more common amongst public agencies. So we will do a solicitation to determine the best rates and terms available for this type of a structure. And this is really the last slide. So I know we're basically at time. I'd rather leave the time for any remaining questions they may have.
Great. Looking to the attendees to see if there's any questions or hands raised. I don't see any. Board members, any questions or comments?
I have a question. How
Kathy.
do the rates compare with the mortgage versus the lease back option?
Yeah, still in the process of evaluating that candidly, so I'm not 100% sure there, but at least in speaking to, so we did do an RFP for the conventional mortgage, and those rates came in fairly competitive. We didn't do a solicitation on the lease-leaseback yet, but in speaking to our advisors, we're told that terms tend to look pretty similar in terms of rates, in terms of loan-to-value ratios, in terms of tenors. Those don't tend to be very differentiated between the two. So I would expect them to be similar, but that's certainly why we would do a solicitation, make sure we compare those side by side and see if there's an advantage of one to the other.
Okay. What kind of rates did you get for the conventional?
I believe all in with the funding rate was about 3%, maybe a little sub 3%. But I mean, I am going by memory, so excuse me if I'm a little off there.
Okay, thank you.
Excellent. Any other questions from board members? If not, that's the, I'll call that item up. And the last point is any board committee comments by board members or items that we would like to include for future agenda items. I'll open it up for comments.
So I have a question.
Okay.
And this is going to be kind of embarrassing, but all the acronyms and so forth in EBCE get a little overwhelming, particularly when I serve on water, which has a whole different set of acronyms. And I was wondering if there's a cheat sheet that exists for the EBCE acronyms, you know, that could be used.
It's a great question. We should put something together. The short answer is we don't have a great sort of consolidated acronyms list. I will put that on the to-do list though, because I certainly can appreciate that it's sort of alphabet soup, so hard to keep track of. And I will do my best to try to spell out things as opposed to use the acronyms.
Yeah, I mean, you do a good job. I just, sometimes it's hard, whereas that, you know, going between the water and the electricity. And luckily I don't have to deal with trash, but I suspect there's a whole nother set involved in stop waste.
I'm happy to take care of the trash for you, Kathy.
Yeah. Thank you.
Thank you, Howard.
And that would be really, I think, helpful if there was a cheat sheet.
I will take that as an action item, and we have obviously a number of functional areas that all have their own acronyms, some of them even overlapping, believe it or not. So all the more reason to try to bring some more clarity to it. So we'll do our best to kind of put together something, and I'm sure it'll be a work in progress, of course.
That would be great. Thank you.
Though I do agree with Kathy, Howard, you and your staff do a great job in terms of at least kind of spelling out what the acronym means at the front end of the use of the acronym as you go through the document. But as Kathy mentioned, sometimes you get overwhelmed with all of the different you know, I may forget what it was on page 3 after we've moved from page 2. So it's just, you know, one of those things that it's an educational opportunity for us as well.
Absolutely.
Well, seeing no more comments, do we have a scheduled date for our next meeting? September the 10th, 2021. And again, Howard, thank you for your help and support. Adrian, thank you for the great job you do every day. And I'll go ahead and close this meeting at 2:03.
Great. Thank
Thank you
you.
very much.
Have a great weekend.
Have a good weekend.
Right.
Thank you.